Ever wondered why revenue recognition is such a big deal in accounting and finance? Well, let's delve into it. You see, revenue recognition is the heartbeat of financial reporting. It's the process that determines when and how income is reported and recognized in a company's financial statements. It's the difference between knowing your company's financial health and being in the dark. Imagine you're a doctor. Your patient's heartbeat tells you a lot about their health, doesn't it? In the same way, revenue recognition provides a snapshot of a company's financial health and performance. It's like the EKG for your business. It helps you understand whether your business is thriving, surviving, or needs immediate attention. Furthermore, it's not just about recording numbers, it's about telling the story of a company's economic activities. It's about transparency, accuracy, and trust. Without proper revenue recognition, it's nearly impossible to accurately assess a company's financial position. So, what exactly is the revenue recognition process? Well, let's dive into it. The revenue recognition process is a key aspect of accounting that determines the conditions under which revenue is recognized or accounted for. It's like a roadmap that guides companies on when and how to report income from business activities. Sounds important, right? It sure is. And here's why. This process involves 4 key steps. The first step is identifying the contract with a customer. A contract can be anything from a formal written agreement to a handshake deal. The key is that it must create enforceable rights and obligations. The second step is determining the transaction price. This is the amount of consideration a company expects to receive in exchange for transferring goods or services to a customer. This could be a fixed amount, variable amount, or a mix of both. Next, we move on to allocating the transaction price to the performance obligations in the contract. Performance obligations are the goods or services a company promises to transfer to a customer. The transaction price is divided among the performance obligations based on their standalone selling prices. The final step is recognizing revenue when or as the entity satisfies a performance obligation. This could be at a point in time or over a period of time depending on the nature of the goods or services. For example, a construction company might recognize revenue over time as it completes different stages of a project, while a retailer would recognize revenue at the point of sale when a customer purchases an item. So that's the high-level overview of the revenue recognition process. It's a systematic approach that provides a clear and consistent method for recognizing revenue, ensuring that companies present a true and accurate picture of their financial performance. Sounds complicated, right? Don't worry, we'll break it down step by step. The first step in the revenue recognition process is identifying the contract with a customer. This contract is the foundation of any business transaction, as it outlines the obligations of each party and the terms of payment. It's as vital as a blueprint in construction. Contracts are of utmost importance because they contain the commercial substance of the transaction. They define the rights of the parties involved, the payment terms, and the goods or services that will be transferred. It's where the magic of business begins. But not all contracts qualify. For a contract to be recognized, it must be approved by both parties involved. Additionally, it must be probable that the entity will collect the consideration to which it will be entitled. In short, the entity should be reasonably sure that it will get paid for the goods or services it is providing. Once a contract is identified, we move on to the next step. The second step in the process is determining the transaction price. Now, what exactly is the transaction price? Quite simply, it's the amount of consideration an entity expects to receive in exchange for transferring promised goods or services to a customer. Think of it as the price tag on your favorite pair of shoes, or the bill for a delicious 3-course meal. But here's the catch. Determining the transaction price isn't always as simple as looking at a price tag or a bill. It requires careful consideration and judgment. For instance, if a company offers a discount, or if the payment is subject to some kind of uncertainty, these factors need to be taken into account. In essence, the transaction price is an estimate of what the company expects to be entitled to, based on the terms of the contract. It's a crucial step in the revenue recognition process, setting the stage for the subsequent steps. After determining the transaction price, we proceed to the next step. The third step involves allocating the transaction price to the performance obligations in the contract. This is where the rubber meets the road in the revenue recognition process. It's all about examining each distinct good or service promised in the contract and assigning a portion of the transaction price to it. This isn't just an arbitrary process, though. We base this allocation on the standalone selling prices of each item. Imagine you're buying a car with several add-on features. Each of these features, the navigation system, the sunroof, the leather seats, have their own standalone selling price. The transaction price of the car, therefore, would be allocated amongst these features based on these prices. It's a bit like slicing a pie. You need to ensure each piece is correctly sized, reflecting the value it brings to the whole. This careful allocation ensures transparency and accuracy in the revenue recognition process. With the transaction price allocated, we're ready for the final step. The final step is recognizing revenue when or as the entity satisfies a performance obligation. The essence of this step, the fourth and final one, lies in the act of recognition. Recognition in the world of accounting is not a nod or a pat on the back. It's about recording, about giving tangible form to an event or transaction. In our case, it's about giving substance to revenue when a performance obligation is satisfied. So, what does it mean to satisfy a performance obligation? Imagine you're a baker. You've received an order for 100 loaves of bread. Your performance obligation is to bake those loaves and deliver them to the customer. When you've done that, you've satisfied your performance obligation. And that's when you recognize revenue. Now, the timing of this recognition can vary. Sometimes an entity recognizes revenue over time. Let's say you're a construction company building a skyscraper. You can't deliver it all at once, can you? No. You recognize revenue as you complete portions of the project bit by bit, floor by floor. Other times, revenue is recognized at a point in time. Think about selling a car. The moment the keys are handed over, the revenue is recognized. The performance obligation has been satisfied in one fell swoop. Whether it's over time or at a point in time, the principle remains the same. An entity recognizes revenue when it fulfills its promise, when it delivers what it said it would. And it's this act of delivery, this satisfaction of performance obligations, that triggers the recognition of revenue. To put it simply, revenue recognition is about keeping promises. It's about delivering what you've committed to and then recording that accomplishment in your books. It's about honesty, integrity, and transparency. It's about giving credit where credit is due. And that, my friends, is the revenue recognition process in a nutshell. Now that you understand the process, let's talk about why it's so beneficial. When it comes to the world of finance and accounting, proper revenue recognition is like a well-oiled machine, keeping the gears of business turning smoothly. It's not just about keeping the books in order, it's about maintaining the financial health and integrity of a business. Firstly, accurate revenue recognition ensures accurate financial reporting. Think of it as a mirror reflecting the true financial position of a business. It paints a clear picture of the income generated and its timing, giving a realistic view of the company's profitability. Without it, financial reports would be like distorted mirrors, reflecting a skewed image that could potentially lead to faulty business decisions. Speaking of decisions, proper revenue recognition also plays a pivotal role in improving decision-making. By providing an accurate revenue timeline, it helps business owners, managers, and stakeholders make informed decisions about future strategies and investments. It's like having a reliable compass guiding you through the complex maze of business operations. Moreover, accurate and timely revenue recognition fosters increased investor confidence. In the business world, trust is a currency more valuable than gold. When investors see that a company recognizes its revenue correctly, they trust its financial reports, and consequently, they are more likely to invest in the business. It's like a beacon of integrity, attracting investors from far and wide, ultimately leading to business growth and success. But perhaps one of the most vital benefits of proper revenue recognition is its role in maintaining transparency and integrity in business. It's a testament to a company's commitment to ethical business practices, reinforcing its reputation and strengthening its relationship with stakeholders. So remember, proper revenue recognition isn't just good business practice, it's essential for success. It's the cornerstone of financial reporting, the compass guiding decision-making, the beacon attracting investors, and the hallmark of business integrity. So, keep those gears well-oiled and watch your business thrive.